Fantastic, thank you. So I hope everyone's fed and watered now and looking forward to the next session. So we're starting bang on 11 o'clock Africa time, as you can see. And our next session is about the growth of Africa's capital markets. Your moderator for this session is Ope Sile, who is the Business Development Manager for Africa at the London Stock Exchange. And she's responsible for the African primary markets business. Her role involves engaging with African companies and other stakeholders such as private investors and regulator to ensure wider access to capital through the London capital markets. The London Stock Exchange has 127 African companies listed on its markets and actively collaborates with domestic exchanges across Africa to support the development of its domestic capital markets, something Ope is really passionate about supporting. Prior to her current role, she worked at Standard Bank, where she assisted and advised African companies in raising equity and debt capital, both in the domestic and international capital markets. Ope is moderating today's extensive panel on the growth of Africa's capital markets, where they're going to be discussing the challenges faced by various capital markets players, as well as what steps can be taken to ensure its growth. So over to you, Ope. Thank you.
Thank you, Sarah. Good morning, everyone. As Sarah mentioned, I have an extensive panel today where we'll be discussing some of the challenges faced in the Africa capital markets and what possible solutions could be. So the panelists here today are capital markets specialists and investors, and are going to share their perspectives. We have Sebastian Waldberg, who is the founding partner of Oryx Impact. We have Reginald Katsutu, who is the Chief Executive Officer of Amana Capital Limited. We have Abubakar Dia, who is the Managing Director of Impexus Securities. Eric Renanda, Portfolio Manager of Emerging Markets Investment Management. And last but not least, we have Nicholas, founder of Sapient Capital. You can get full details of their bios on the app. So we're going to start with you, Reginald. Let's talk about the relationship between the growth of the real economy and the capital markets. Which is a prerequisite for the other? Is it a chicken and egg situation?
Yeah, kind of, chicken and egg. At the beginning, the economy needs to grow so that then you have a capital market in place. But then for sustainable growth and quality growth, then you need a proper functioning capital markets in place to drive growth, because then you need a vehicle for your private sector to be able to get funding. In the context of Africa, have we seen a correlation between growth of capital markets and growth of the real economy? Statistically speaking, it is not a very strong correlation. Because if you look at most of Africa's real economy, growth comes from government expenditure, either on infrastructure and the nature of that. The main players that have been there in the capital markets in Africa have been the banks and recently now the pension funds. They are the main aggregators of saving when you come to the African market. However, they've not played a very good role in terms of allocating that capital. Because the purpose of a capital market is to be able to aggregate savings, then be able to allocate it to the most productive areas of the economy. So if you look at most portfolio books for the banks and the pension funds, close to 60% of it is actually in government paper. So case in point, when the government of Kenya is issuing an infrastructure bond at 14% tax-free, as a treasury guy seated at the bank, I have money, I'm thinking, there's this SME that needs money, but there's the government offering me 14%. Why would I take the stress of following up on Sule's loan when I can give it to the government and they can literally give it back to me tax-free and at 14%? So I think for us to see a correlation between the growth of the capital markets in Africa and the real economy, we have to restructure our capital markets in Africa. What do I mean? They should be able to aggregate funding from DFIs, these PE funds, and all these other institutions, and all this money that you've been seeing walking around this building, be able to aggregate that funding, then de-aggregate it again to the SME sector, because 80% of the African economy is small to medium enterprise, and not the West definition of SME. They are micro. Guys who are buying stuff in China, coming to resell, or someone who's making soap in their backyard, selling to one or two guys. That's the African economy. The African economy is not your few big guys, it's not your MTNs, it's not your Standard Banks, it's not your Safaricoms. It is actually the SMEs who are driving African economies. But our capital markets are not structured for these guys. So until our capital markets can aggregate funding, then still de-aggregate it to the smaller SMEs, only then will we start seeing a correlation between the growth of the capital markets and the real economy.
Interesting. Thank you, Reginald. And let's talk about, investing in African capital markets. Eric, you invest in public securities across emerging markets. What will you see as some of the positives and negatives of investing across Africa compared to other emerging markets?
Maybe I slightly disagree with Reginald. I think
Okay.
for where Africa is, I think generally the markets work pretty well. Put South Africa at the top of the pack. I mean, it works like any developed market. Long, short, interest rate futures, index futures, you can do anything in South Africa. And and the currency is hyper liquid. Then, for the rest of Africa, the markets that are developing like Kenya, Egypt, Casablanca, Lagos, Ghana, they're pretty good the stock exchanges work well, regulation's good, electronic order routing, everything works pretty well. You can't short in those markets. And then also you have these fixed income markets working pretty well. I traded local currency debt in most of these markets. You get quotes, 3 or 4 quotes on everything, traded electronically. So I don't have a problem. Most of these things are good. I think the thing about the micro stocks, I think, they're just small. So there's guys that want to put $50 million to work can't put it into a guy selling cell phones on the street. It's just not a listable company. But the part where that really hurts is on the FX. And this is getting better. You're now down to maybe Zimbabwe and Nigeria that are having this problem. But when the government or the central bank is trying to control an exchange rate and manage it away from where the market is, and you have problems getting money out, that's the real fear that outside investors who are not participating in Africa, that is what that's their biggest nightmare. And I think other places like Egypt are getting better about it. Like they're trying not to have it happen. Kenya acted very well in the stress last year, couple delays, but liquidity was great. So I'd say it's just getting Zimbabwe and Nigeria kind of the last things, but I have to say overall maybe it's improving. But that's the big remaining thing.
Okay, glad to hear it's improving. Abubakar, I'd like to hear your thoughts on that as well, and what you think are the major factors hindering the development of the capital markets across Africa. And second question for you, how important is a formal collaboration and coordination of regulatory and legal frameworks across African exchanges?
Thank you, Ope. I think I'll begin with the second question because the regulation is very key. And if you would like to develop the market, we need to have even the same regulation by region and even by countries. Mm-hmm. And if I take the example of the WAIMU region, which is French-speaking West African countries, we have one common market at BRVM in Abidjan, but between the different countries, you have some different tax incentive. So meaning for the same investment, based on the location of the investor, that will not be the same net return. And I think this is this type of things that may first need to be dealt with. Secondly, also, we have, in terms of attracting investors, we are talking about attracting foreign investment, but the main point, in fact, will be first to reallocate or to allocate properly funds that are in the region. And we find many institutionals and local pension funds that have enough money, but more using, let's say, bank deposit or something like that, because they are not, in terms of financial education, if I can call it like that, there is some improvement to do. The third point also is in terms of product. As said, regional, I think also we have some blue chip companies, big corporate governments acting in the market, but the masterpiece of the economy is the SMEs, is the informal sectors, is sometimes also project to be financed. And in order to allow, let's say, the regulation to allow some type of project bond or basket bond for the SME or some stuff like that, that will allow and help the real economy to leverage on the capital market to develop the region.
Okay, thanks. Abubakar, you actually spoke about products. I'm going to go to Nick next because that's your area of specialization. So a key constraint, as Abubakar mentioned, is the limited number of listed instruments that we have or products that you can trade. How can we tackle this and become more innovative? And what other products can be explored?
Okay, so I think the key issue in Africa is liquidity of the stocks. It's cost of buying and selling. And then is the lack of free float. If you take the all shares, and I exclude GSC to a certain extent, you will find that there is very rarely more than 30% free float in the market. So then you have to look at why that's the case. So for the listed entity, the sponsors or the main owner, they just don't want to lose control. So what it means also is that in terms of, now you look the other side of the balance sheet, in other words, the investors, and you have domestic and international, your hedge fund activist investor is not going to invest in Africa because he cannot bring change, because there's full control. They will not be listened to. So that's already a whole bunch of people ready to take risk in emerging market and frontier market, which is excluded from the equation. The DFIs, they tend to be investing more in project than in actual shares. So that leaves the domestic market. And the domestic investment market is still very small. And the way that people invest, particularly in your part of the world, is that people look for a dividend yield. Yes. So they buy a Sonatel share in Senegal, but actually they're only interested in the yield, which Babakatel told me is now about 10%. So why take an equity risk for a dividend of 6% if you can get 10%? So I think the solution is quite clear that that is a win-win situation for both the listed entities and the investor, is to issue preferred shares. And preferred shares are a capital structure. It's tier 3 if you are a bank. If you're not a bank, doesn't matter what it is. It's a capital structure, which means that when an investor wants his money back, it doesn't go to the company, he sells it through the market. So it's permanent capital for the company. It doesn't have voting right, so it's perfect in terms of controlling the company. So it's great, very attractive for the listed entities. For the investor, he knows he has his dividend yield. It's a fixed rate. It's reviewed every 5-10 years. There are various models that you can use to issue preferred shares. Even in Europe, the denomination can be as low as £1,000 in the UK. So it's not like you have this massive hassle that you have to have 100 million issue. So I think it brings all the advantages of fixed income for the investor and permanent capital without voting dilution for the investee or the listed entity. So I think that personally, that's the one product that I would say it's simple to understand. The brokers system, as Eric mentioned, actually is working very well to buy and sell shares in Africa. They usually always do also fixed income. So it seems a logical, well-tested product that should be promoted on the continent.
Okay, that's interesting, Nick. That sounds like a very good idea because there's always this disconnect in the markets where one person, whether the investor is happy, but the issuers aren't happy. This is more like a product that unifies
and less
those
volatility.
two. And less volatility, yeah. Okay, now let's talk about how we can actually attract investors. I mean, you've mentioned one of the ways, in terms of product innovation. Sebastian, how can we attract significant capital into the African capital markets, and this is both quoted and unquoted, and create scalable impact?
Yeah, thank you. Okay, I think, we come from this from a slightly different angle than I think most of the other panelists. So we come of it on the one hand from the impact side, and on the other hand from the sort of mostly unquoted side. So we're really looking at how can we attract more capital into the continent in those sort of areas. And of course, the capital markets are absolutely key because that provides, again, the exit opportunities for some of the investments made by the private equity and venture capital world and so on. So it's obviously very correlated, but so what we think in a way is that we need, and a little bit in line with what Nicholas said, is there are certain products which are required, which are not there yet, or there's very little of, and to get people to invest, particularly the private capital. So of course the DFIs are doing a lot of investments, particularly in the sort of in the unquoted areas. But what I think we need the DFIs to be more creative and more innovative to attract more private capital into those kind of investments. And to do that is, and how we're going about this is really to create sort of fund of funds which allow a diversified approach towards the investing in African private markets. And that allows to diversify your risk, to diversify the geography, the asset classes, the sub-asset classes, and the sectors and so on. And then have vehicles of a certain size. So obviously with a few exceptions, but particularly in the sort of impact area, you have relatively small funds, which makes it very difficult for institutional investors to invest into them. And so to bridge that gap between the sort of smaller and mid-sized kind of funds, which then invest mostly in SMEs, and I think there's a lot of agreement how important the SMEs are for the continent, and then of course to also attract the capital. To bridge that gap between those sort of smaller mid-sized funds for institutional investors. So if someone goes out and says, I have a 80 to 100 million whatever dollar fund, or institutions say, oh, that's very interesting, but I can't even talk about it because I can't allocate. And so bringing more sizable investment products to the market we think is extremely important. The other thing is, of course, is success stories. So it's really about creating those success stories in the private and in the public markets. And I think we talked about this before briefly, that there's the performance it hasn't always been there. So it's really important that these success stories are created so that people can see the track record, see the performance, and invest. And again, particularly the institutional investors. The way we look at this is, of course, from a sort of SDG perspective. So if you think of the SDGs which have to be achieved, if we want to achieve the SDGs by 2030, by 2050, there's a huge amount of capital required, and there's a lot of opportunity, and I think it's a lot about communication as well. And actually, events like this and others are really important to get people to become comfortable with investing. So I think those would be my sort of answer to that.
Okay, there's one other thing we're working on at Emerging Markets Investment Management, is we want to list a Africa closed-end fund on the LSE so that anybody in the world can buy and sell and trade, invest in Africa, just through their local brokerage account. So,
Okay, that's good, Eric. We should have a conversation after.
Right? That's something that we can all work on.
Yeah, sure.
Maybe to pick something on what the gentlemen have mentioned. If Eric is an investment manager, his main goal is how do I get alpha from the money that he invests and all. So if you realize African capital markets are designed or have been structured or have grown for people like Eric. And that's why I'm saying they're working well, because he's able to do what he's supposed to do. He's able to buy a Kenyan government bond, sell it, get his money out. Unfortunately, that's why he has picked on Zimbabwe and Nigeria. But he's able to do that. So it is functioning for him, but not functioning for the real economy. Because 90% chances when Eric is selling his Safaricom, it's being bought by another PE fund, which is not domiciled in Africa. So that money is not circulating in the African continent. So we really need to figure out how do we make the capital markets, or what metrics are we going to use to say that our capital markets are growing? And that's where Sebastian comes in. Are we seeing an impact from the growth of the capital markets as the main matrix of saying, are our capital markets working? Are they allocating capital? Because the major role of a capital market, apart from aggregating saving, is allocation of that saving. And if our capital markets are vehicles that are allocating capital to government securities, who are the poorest allocators of capital anywhere in the world, whether developed or undeveloped, then we're going to have a problem. I'll give example again of Kenya, for example. There's been no listing in the Nairobi Stock Exchange for the last 10, 12 years. And for me, that's a clear sign that there's a huge problem. There's been no new listing for the last 10, 12, and this is one of the superstar economies in on the continent. There's been no new listing. Why? Because there are no businesses that, one, are accessing funding, which need the equity market as an avenue to be able to list out. And of the listed companies that are there on the capital markets, you have 5 stocks. Yeah, actually we call it Nairobi 5 Exchange. You have Equity Bank, Safaricom, KCB, Cooperative, and EABL. And if you look at the trading volumes of these 5, 60% of it to 70% is foreign. So when foreigners said, we are not buying these shares, the stock market is dead. When they come back to the market, the stock market is alive. So our capital markets in Africa actually structured as a vehicle to allocate capital in the economy, or they've been structured in a way that allows professional investors, institutional investors to be able to come in, make the alpha, but no impact on the real economy.
Yeah, I agree with that. So in terms of making domestic investors, let me specify, even more active in the capital markets, what do you think is the role of education for them to actually understand products, how to allocate their capital, risk of concentrating capital in just government bonds, for example?
I think civic education is needed on the retail side, but not only just on the retail, even on the institutional investors that are in Africa. Because if you look at the pension funds and the collective investment vehicles that are there, your unit trust and all, their asset allocation is 60 to 70% into government securities. And regulation has played a role in that, because if you, again, look at most of the prudential guidelines by most of the regulators in Africa, you'll find you're only allowed 5% to 10% in private equity. You're allowed up to 100% in government securities. You're only allowed 20%. So even as a fund manager who's managing a pension fund, your hands are tied. Because honestly, you'd rather just put everything in the government security instead of trying to explain to your trustees why you lost money in Nakumat, why you lost money in that. So from the institutional perspective side, there's a lot of education that needs to happen on the regulator front. And the education for these guys is that your role is to allocate capital. And as you allocate capital well, the economy grows and your returns also grow. On the retail investors, I think most desire to invest in equities and in the capital markets, but Africa has a huge income poverty problem. So when you end up looking at where your disposable income is, and you're thinking, this is my last $100 which I need to save, are you going to put it in a risky stock, or you just rather put it in a fixed deposit or a government treasury bill? At least you know I will get my money back no matter what happens. So I think there's an income poverty problem that needs to be sorted out from a macroeconomic level, because when we used to have IPOs in Nairobi, you'd find a lot of retail people who would come in, a lot of retail investors. But once the IPO is done, it dies. There's no more activity. So there needs to be education on the institutional investor side and the regulator side on their role as allocators of capital. And then on the retail side, I think there are other problems that we need to fix before we even start trying to encourage them to get into the equities market.
Yeah. So I think you've actually answered my last question to the panelists, but I'm going to go round. You know, if you could pick one thing that your organization, as well as other companies in your industry, should be doing to contribute to the development of the capital markets, or if it's one thing that, you know, another party should be doing, what would you say that is? And we'll start with you, Nick.
Well, so I also run a commodity trade finance fund, and we had a case in Uganda next door to you, where some guys wanted debt. We discussed it before the meeting. They wanted debt, but they were over-leveraged, and said, you need to raise equity. And said, well, how do we do that? And this was like a $15 million loan we were making. They said, well, PE, you're too small for PE, but try venture capital and try crowdfunding. And they raised in 3 weeks nearly $500,000 from the US in crowdfunding, from people putting $1,000, $2,000, and became like a private investor feeling very, rather than putting money into private investor in the US, feeling very committed now to their project because they had put some money. So there is also this whole crowdfunding platform that exists in Europe and America, which is underdeveloped in Africa, which I think could be the next source of capital for people. A lot of them are the guys who want to do good and are not necessarily obsessed with a high rate of return, but they want to see progress. So I think there's this whole direct connection between the private money in the West, let's call it, and the requirement of SMEs that can be addressed via crowdfunding platforms.
Yes. What I can say is on our side at the Paxis, for the last 3 years, we are making a focus on developing the corporate bond issuance in our market in West Africa, because we think that that will be very important, as said originally, in order to develop the government to try to bring alternative source of financing for the real economy and for the corporate. And for this, we're trying to do it with two means, having foreign investors, one part, but also mobilizing the funds at a local basis with local investors, pension or retail investors. And what may help on this would be to have tax incentive, because I think even as he said, you have many investors not coming in the stock market or not coming in even the fixed income market. It's I think the government or the regulators, they need to put more incentives at the first level in order to help growing this market and help allocate, because alternatively what you have is only the banking system, and it's structured in a way that it cannot address all the problems of the economies. The second one is, as we said in the product, right now we know that on top of making issuance for big corporate, to try to see how to issue for SMEs, and we see that for SMEs, if we would like to issue, due to the fees and all of this, that may not make sense. So we're trying to see a product like the basket bonds. We are now going to issue what should be the first green bond in the region, trying to attract also foreign investors, but also local investors on this. And last but not least, it's regarding now, we know that at the regulation level, they are finalizing, as I said to Nicholas just before the panel, maybe within the next 6 months, a specific regulation for private equity in the region. And I think that will bring another wheel in the global picture, allowing to allocate capital and not just having funds, even if it's in the same region, having PE funds based in Mauritius but acting in the continent, but having also more incentive to develop both the PE fund in Mauritius but also in the region and attracting more capital. But the underlying things will be to allow the local investors, private, retail, institutionals to come more in this market, to have incentive to diversify and not going only on banking deposit and stuff like that. Yeah. Thanks.
I think additionally to that, so I think that's really, really good news, the change to regulation for private equity. Of course, it's really good news for local investors coming into the private equity funds locally. But from our perspective, from a sort of impact perspective, I think what is really important is to be able to report on the impact and really show that there is measurable intentional impact being delivered to the investors. So of course investors want their financial return, and we all know how we calculate financial returns, and but that there is standardized reporting which can be documented and audited on the impact KPIs which people sell when they raise the money, so that the investors really get what they were expecting, on the one hand on the financial side as well as on the impact side. I think that's really important. Another thing is, that's just a general kind of, but more and more success stories, and of course that means invested maybe going through a number of investment rounds in the private equity space and then being able to go to the markets and have liquidity there and be successful. I think that's another one. And the third one, I mentioned briefly before, but is that the DFI and the public money which is being invested in the continent thinks about new ways of doing that and being more catalytic for private care. So not just investing into projects and with other DFIs, but really trying to be more catalytic to get private investors at large scale into the continent. Again, I'm always talking more from the private side than from the capital markets, but that would be my sort of take.
This is the question: is what should these various people be doing?
So what should your organization or other organizations in your industry be doing, or any other capital market player? If you could pick one thing.
Okay, as a London asset management company, I think we're going to do the closed-end funds. For the regulator, I really like Nicholas's idea about the crowdfunding. That's a really big deal. But the regulators in the US had to modify all the regulations to make this happen. So the African regulators are going to have to be flexible to do this and change some rules to make this stuff happen, to have smaller securities offerings. And then, so that's the regulator, that's what they should do. And then the central banker, please do not screw up the currency and trap everybody in the currency and create billion-dollar queues, because then that destroys all the good work everyone else is doing to make the thing work. So that's my...
Okay, thanks, Eric. I think we have some time to take questions.
Yeah, hi, my name is Stanley Agnete from Triodos. Thank you very, very much for a very interesting panel. I mean, I think we all here understand that, a truly functioning and efficient capital market is actually going helps any economy actually go forward. One of the questions that we were trying to address in Africa is that, what do you think, from your own perspective, what do you think is going to drive, what do you think is going to take to actually drive the growth of our capital markets? Because, I mean, do you think it's going to be more foreign capital, or actually trying to cannibalize local investors to actually get involved themselves? Because, I mean, one of the things that we're trying to see is that international capital sets certain rules that are misaligned to the local capital market and the local environment. So how do we actually get this alignment to actually happen? Because I think that's the only way that this growth is actually going to happen. Thank you. Anybody can answer that.
Is this to me?
Sorry?
Is this to me?
No, to anyone.
Oh.
Well,
What's the misalignment of the investors versus the international investor misalignment versus the local?
Because, I mean, one of the things that everybody keeps talking about is the lack of, appropriate investments on the continent. And if you think about it, that mindset, there's already a misalignment, because it's not a lack of, if I can say, investment, it's a lack of misunderstanding of the local operating environment. And that is one of the challenges that we're facing. Now, the question is that, how do we resolve it? Do we need more local participation, or do we need to jack up our legislation and regulation in order to align with international capital markets?
Sorry, I still don't understand the misunderstanding. What does the foreign investor not understand?
I work for an investment bank, and every single time we go to look for investments in the continent, we try to apply the mindset that we have from the European community. We try to apply the same regulations. I mean, people talk about ESG expectations. People talk about, corporate governance expectations. But of course, the environment is not ready. Some of those elements are not really in the environment yet, and they're only going to come later. And my question to you is that, how do we actually look at that environment with the knowledge that that environment is a little bit behind, and how do we actually progress forward with this?
Okay, let me try and pick that up. Okay. I think Nicholas mentioned part of the answer to that is, how do we come up with solutions? I don't like calling them products. How do you come up with solutions or vehicles, one that aggregate funding from outside, which can be de-aggregated to the local? The misalignment comes is when you come to an African economy thinking you have billion-dollar companies, where 90% of the economy is actually driven by micro, let's remove the word SME, by micro enterprises. So the question is then, how do we make these micro enterprises get access to funding. The DFIs would come and dump money in a commercial bank because they don't want to take the risk, they don't understand, so they'll dump the money in a commercial bank and tell you onward lend to an SME. But once it enters into a formal banking institution, the rules of that bank operate. So you find they will not be able to give you a long-term loan. They won't be able to, a bank won't be able to buy equity. They will most probably just give you debt for 2-3 years, and by that time you've not even broken even. So we need to come up with vehicles that aggregate this funding from outside so that we then de-aggregate it down to the local SME. Crowdfunding is a good thing. My organization is actually working on something on crowdfunding where we aggregate funding but de-aggregate risk. So that pension fund, which has $1 million, $2 million, instead of it putting $1 million in an SME by itself, in a crowdfunding way, this pension fund is only putting in 200,000. The DFI is quasi-guaranteeing those investments by also putting an amount in it. So you've de-aggregated risk, but aggregated funding for this SME. So we need to come up, or our capital markets need to come up with vehicles that, one, that understand that the economy in Africa is very informal, and for us to grow it, we need to not exactly formalize it, but grow organizations to the level that they formalize in the process. Export-oriented SMEs, and not the guys who sell phones, but export-oriented SMEs who just don't have capacity, and they don't have capacity to scale because they don't have funding.
Can I add something to that? I just think that there's one other element which is around transparency and managing of expectations. So I think it's really important that if you manage the expectations in terms of that misalignment, as you call it, then I think people don't get disappointed because they know beforehand what they're getting in, and I think and then transparency in reporting on that. So I think it's, there are many markets which have emerged. I've lived in Spain for the last 25 years and when I first started doing venture capital in Spain 25 years ago, it was a sort of nascent market and there were very few exits and so on. And it's about educating people, but investors as well as everybody else, and being transparent about that. So I think that's an important part.
Okay, I think we can just have
just
one more
before
question.
I go, just one last thing, and I think that's the point that I was trying to make, is that if you look at current investment from international community into Africa, 60 to 70% of that investment is all going to foreign-owned companies or like international companies that are set up in the environment because of the mere, and that is causing local entrepreneurs to be crowded out of the capital market. That's the misalignment I'm talking about, because those foreign-owned companies that are local actually has an alignment with the investment ideologies of the Europeans, so they're all getting the money. And that's what I'm saying is that how do we correct this misalignment in order to actually make sure that local entrepreneurs and local businessmen are also equitable to this capital? I mean, if you look at some of the entrepreneurs that are presenting here, most of them are foreign-owned companies that are setting up fintechs and things like that on the continent. And that is actually starving our local entrepreneurs. And that's why I'm asking, the capital market has to realign, or this is going to continue over and over again. Thank you. I'll leave it here.
But what are you saying? Like the international guy wants to put his money into the market and he wants to go buy the Diageo subsidiary, or he wants to go buy a payments company. But then you say, whoa. There's too many of you investing in that. We think it's better if you buy the cement company. And you go, I don't want to buy a cement company. No, but that's better for Africa if you buy it. Is that, how would it work?
How would it work is that if I'm a fintech, I'm an African founder, and I started a fintech, and there is also a foreign founder who also started a fintech, I do believe that more benefit should be put on the African founder than the foreign founder when it comes to capital markets alignment. Because don't forget, we're talking about developmental capital, not traditional investment. And developmental capital is actually meant to develop the ecosystem by providing the necessary profits for the ecosystem to grow. Now, by investing in the foreign, we're not really developing anything. We're just providing services and we're providing employees rather than growing the ecosystem. And I think that, for me, is the biggest challenge that we're facing on the continent for both entrepreneurs and for local developments.
I think maybe before we round up, I'll just give you my thoughts on that. I think instead of, instead of basically restructuring the capital markets for that, it's really working on educating entrepreneurs to get up to a certain level and to adopt certain policies where investors, and both domestic and international, can actually feel comfortable. So if, for example, if he wants to invest in Diageo and you say, oh, this is another company, and he looks at the company and he's comfortable with the company, then it's easier to have a conversation then as against having to scale back your requirements because you want to invest in a company that's not up to par to develop Africa. I mean, it has to be a win-win situation on both sides.
Okay. The other thing also, there's 125,000 millionaires in Africa, we learned this week. They need to put some of their money back in their markets. And I think the answer to your question is the problem is domestic. You need to get the people to open their wallet, those who have something in its surplus, and to be comfortable to invest. And I think these people, like my two neighbors, who are asset managers who can draw that money and then disaggregate properly, and that's going to take time. And once the domestic market works well, suddenly the foreign money will come in at that level, because at the moment, a CDC in Propaho can't invest in a $200,000 company. It's simply not feasible from a human resources point of view.
I mean, thank you very much. The panelists will still be available if you want to continue that conversation or if you have any other questions. Thank you very much, everyone.
Thank you.
Thank you.